Good evening. This is the Eye of the Storm podcast with the big picture update for the SPX, the NDX, and the Treasuries, the 30-year bond, the 10, 5, and 2-year note, and tonight also the dollar index. Beginning here with the equity market, so we're going to start with the SPX. It was what I would say a crazy week, not the easiest week to trade within the equity markets. We saw a lot of volatility. We saw a lot of trades being done focusing on 0 days to expiration type options. So options that they start trading in the morning and they're done that day. So they're 1-day options. And they become very popular. And they are really constituting within the options total volume in options and derivatives, the 0 DTE across all the asset classes are really totaling close to 42 to 45% of the option volume. And that's on a daily basis. So a lot of attention has been given to those, and that's really creating a lot of change, not necessarily changes, but the way that I view things. But they continue to follow decent Elliott, but in terms of the overlying or the overlay, which would be the fundamentals, which would be if we start at the top of that pecking order that I constantly talk about, that we're looking up at the interest rates. That's what sits up at the top. And then what comes down next is going to be the bonds or the T-bills or just all of the interest rate derivatives. And then coming down, we have the currency, because your currency is going to be affected by your interest rates. Coming down from that, you have what I call corporate, which is truly, again, our marketplace. So it's the equities, it's commodities, et cetera. It's like all of the different markets. And then underneath that are us, the retail, the trader, the people. And eventually, all of these things roll down, eventually affecting how they all trade. And coming down to that bottom, it affects how we trade. What do? Do we buy? Do we go long? Do we go short? Are we looking at a long-term basis, short-term basis? And just the moves within the markets have gotten somewhat confusing. And I think a lot of that has to do with the constant role of narratives. But to be honest with you, I really think what it comes down to right now is that we're still hanging on to the premise that either you're bullish or you're bearish. Either the market's going up or it's going down, and going up is a positive, going down is a negative. All of those things that have been surrounding and really holding what I'm going to call bondage, holding a lot of traders in bondage, because that's not necessarily how the market is trading. So you're coming in and you're seeing, for example, on Friday, late Thursday into Friday, 2 strong rallies. So why is everybody getting bullish? What's going on? Oh, they're relaxing over here, interest rates, et cetera, et cetera. Look at the interest rates are kind of correcting too. They're really changing. And so interest rates are going to be down, or the Fed. So they're trying to draw every hour of every day a picture that goes all the way back up to interest rates, when actually it doesn't really go that far. Interest rates, that story has remained the same. Interest rates are going to go up. Inflation is still kind of running pretty strong. So interest rates themselves are rising. And again, I'll demonstrate it and show that when I get into talk about the interest rate sector and the treasuries in a few minutes. Interest rates took a big jump last week, and they took a big jump the week before. So that's all in preparation for what's coming in March. We have a Fed meeting now, but they're already, if you take the market's already moving out beyond that. Well, what happens? Okay, we're already going to accept that March will be a 50 basis point hike. Okay, what are we looking at? What's April going to be? May going to be? June going to be? So they have to go out to the June, July, or actually the June future. And then that starts to trade. So again, you still can hold to the concept that the market is always looking forward, but understand that the market is looking forward under the premise that interest rates are going to continue to go up. So in that respect, the market is accepting interest rates are going to continue to go up. And what effect should that have on our equity markets? Well, to be realistic, the market should continue to go down. Well, what's preventing it is when we see these strong rallies that truly are going against this narrative of higher interest rates, but we also saw a recovery in the bonds. And that, again, folks, is a lot to do with just the natural ebb and flow of a market. And so when we got that, we're tying it all in, the larger picture is not changing. Just this daily picture, or even cutting it even smaller, tends to change. And that again produces our trend and counter trend moves. So when I'm counting Elliott, I remain in a counter trend move in both the SPX and the NDX. So here we're going to take a look at the SPX chart. And what we've got going on is we had the intermediate A wave and intermediate B wave, and we're in an intermediate C wave down. And honestly, we're still in that upper third of it. We've finished wave one. We're now moving higher in minor wave two of this intermediate C wave down. Remember, waves 1, 3, and 5 will be down. 2 and 4 will be corrective. We're still in 2. And within that, this is where it kind of can get interesting. That the SPX, here we have the bottom of minor wave 1. Minor wave 2 will consist of an ABC structure. We have an A, there's the B. Well, wow, what happened there, Michael? Look, the B is putting in a new low below the 1. Yes, we're seeing more of this, where this turns into an irregular B wave. They're not as uncommon as we would think, but they happen most often on a larger a time frame. So they take longer. This one just happens to be on a minute within a larger minor degree. So it's actually a minor degree move, but the internals are showing that this was an irregular B. So the B wave goes down, in this case, puts in a new low below the low of wave 1. So we get an A, a B, and then we get this rally. Now, in all honesty, that level that was reached on Thursday, just before the opening, or actually at the opening, reached a low, put in that B wave, bringing us into a C wave rally. Counter trend move, yes, but the C wave, which will be up. And sure enough, it kicked in. But we used the Fibonacci to tell us how far down an irregular B wave could go. And it hit it right on the nose. It was 1.382, and that is of this A wave. So the Fibonacci would be you're measuring the A and you're looking at what the retracement should be for a B wave. Well, you put them in so that they show up, and they also include an irregular B wave. And those levels would be 1.236 to 1.382. And this came down 1.382. Now, once the C wave gets engaged, your most common retracement back up is 1.618. We reached that on Friday. So this gets to be very, very interesting in the markets right now, because I have a couple of ways that I could possibly count this. This was extremely powerful, and it truly was from Tuesday morning all the way through to Friday's close. So I can interpret it as we're looking for C wave. C wave will be 5. But then I'd have to count 1, 2, 3, 4, and this is the 5th wave. And it just doesn't, it doesn't. The 5th wave just makes the 3rd look like kids play. So based on that, I take a step back and thought, okay, wave 3 extended. So it's 1, 2, and then we got a beautiful 5 inside that to produce just at Friday's high the third wave. Well, what then can we expect from that point? Well, I can start by just putting in these extensions, and the extensions show we almost that 1.618 comes in at 40.49. The cash market, so this is basis to cash, and the market got up to 45, I believe. No, take that back. Yeah, no, 48. So it came within 2 points, but that still is there. And then above that is 1.70.5, so 170.5. And that fib is an old market maker fib. And it was brought to me as through another trade room that I was associated with quite a while ago. And so this was a market maker level used on the floor of the Chicago Mercantile Exchange and used in several pits. You'll find it in the bonds, you'll find it in the SPX, you'll find it in crude oil. A lot of those products. So it was a point where it would come to and then reverse strongly, or market makers would sell it or buy it depending on what level it was coming in. This level would suggest selling it. So if this is a 3 and we're now looking for a 4, I would think that under the current environment, that if we get a turn in the bond market, if we get a turn in the dollar, it will just kind of flow over to here, because the only bias that we have underneath that it was options related. So in other words, derivatively related. And you've seen me go through, or I'll go back during my Elliott Wave updates, I talk about the open interest in the options. That's truly what happened. But as those trade, the hedge on those is within the index. If you're trading the index is comprised of 500 stocks. And many of them will be, affecting the price. Collectively, that's how you get the S&P 500. And so with that in mind, it wasn't a statement that anything has changed in the bigger picture. Again, when I get over to interest rates, you're going to be like, oh, those didn't change. They actually went up. So why is the market rallying? Because there were, in the SPX options and in the ES options, 40.50 was a major strike price. It was a wall. It was for both directions. Now, the ES managed to close above 40.50. And the SPX closed at 40.45. So the 450s in this particular market were probably more relatable down to the 440s, to the 445s in the SPX, because there's always a little bit of premium, extra interest in the S&P. Now, having said that, technically, I'm going to leave open that this is a third. We're going to do a fourth wave decline, so a counter trend within the counter trend, and we're going to come down. And our support first lies at 40.39. This is the cash market. Then at 40.31. Then we're coming down towards this 20 at 4,000. Can it drop 45 points and still go up? Yeah, it can, because the first wave is way down here. So we might see a little, we should see, and again, I don't know if it'll all take place. Don't forget tomorrow, the futures start trading, and they're going to try to balance it out with where they think everything's going to open on Monday. So we won't know until Monday on the SPX itself, because it's cash. It's the cash market. In any case, if we get a small 4, and it could be a blip, again, because it'll take place via the future tomorrow. Now, and then we get a fourth wave in, maybe it comes down to 40.31, maybe it comes down to 40.20, and then we rally back We get up to 40.55, that's that new high, that's resistance. It could be counting as a 5, and then we get a C wave, and then the minor 2. And again, the same story, whether this is a third or whether that's the top. This Friday, it carries the same message. If we have additional upside, we got 40.55 and they got 40.78. And yes, I will include 4,100. You have to, if they're really going to kick it one more time. For no other reason than where things need to expire on Monday, or how everybody's coming out of expiration. How does it settle? Where does it settle? How do the stocks settle? You know, don't forget, in the underlying, in the individual companies, that is stock. Either you're long or short the stock, how much you're long and short the stock, et cetera, et cetera. The future, both the NDX and the SPX, it settles in cash. So, small 4, leaving open for a 5. If indeed this completed it, then we should just turn and we should start to reject it. There was no rejection of this level because they had to buy it up to the close to get that close. So it would be pretty amazing that if that was it, that's all we really wanted, don't worry about it, we're not really looking for any more, and they just start hitting it come Monday morning. And that would mean that all these stocks turn and start to go down. That would also roll over and suggest that the bond market should do the same thing. We'll see. So there's both sides of this story for the SPX. We could get a little 4, expect another rise, and then that rejection and the start of a minor third wave, which should begin exactly as I'm telling you. If I'm saying that this needed to go up and not look back, that's exactly what it did. So far, it is fulfilling exactly what the market needed to do to get here. Because I think once people get to realize, wait a minute, nothing's changed, they will join with others and start selling it. That's my feeling. But we have to allow the technical move to bring it all the way back up to here. That does still exist. If this is the end, it's going to roll and it'll just start. Breaking the 4, the 8, the 20, the 50, just start going. At least get itself back below 4,000, because that's where we gapped from. I mean, if you're a gap trader and you follow that, then what the initial move down should be, fill the gap. And the gap actually is, 39.96 down to 39.80, let's say. And that needs to be filled. So that would be the first move. Little rally, and then just continues, because you're definitively, if minor wave 3 gets engaged, I am for certain looking for a new low below 39.43, which is where minor wave 1 completed. Ultimately, again, this would all just be conjecture, because I'm not sure that this is complete. But should it be complete, then I'm going to jump back out to my 4-hour chart, and we're going to take a look. Because now what I have is 1, 2, and now I can try to decide what would this third look like. Again, I'm going to use Fibonacci extensions. 1, 2. And I'm just using it to Friday's close. I do not take it down to that B. I take it to the bottom of wave 1. It's going to be more accurate. So initially, wave 3 definitively should be at least 100% of wave 1, and that would bring us back to 3,800, 37.95. More likely, the third wave being the strongest and the longest, you're looking at 1.618, and that would be wave 3640, we'll call it. But wave 3 can come in much bigger. Wave 3 can just really put in a nasty, take a huge amount of quick, so a huge amount of real estate, so to speak, and just drop way through all of these prices. Now, what can do that? It's more people are going to think, oh, it could be a black swan. Sure, it could be, but just anything super negative. It could be on the geopolitical, could be with the Ukraine, could be something happens in China towards another country, or even the United States. There are a lot of situations bubbling all around us, as well as interest rates. We are seeing in Europe that they're still feeling very pinched in terms of utilities, in terms of natural gas. Being able to heat, being able to do a lot of things. So the continent, along with the UK, they're feeling their part. How is that going to affect us? It all kind of rolls down, but within our own country, we are seeing the interest rates make some big strides to moving, with rates moving very quickly higher. All right, before I do get the interest rates, let's cover the NDX, and then I'll move over to those interest rates. So back here in the NASDAQ, same deal. Here we are on the 4-hour chart. We can take a little bit of what our big picture is. Intermediate wave A, B, C, intermediate wave B, that C wave ending in a failure, or the fifth wave actually ends in a failure. C wave, B wave come on top of it because the fifth wave did not take out the top of wave 3. So what we have coming off of here is minor wave 1. Then we have an A, a B, and the same deal. We're into a minor wave 2, but we're inside the minute C wave as that starts and continues to unfold. Now, where do we get up to? We got up to that, and let me take this down the hourly, and we can look inside that. All right, the 50%. So we're looking at where minor wave 2 would be equal to 50% retracement of minor wave 1. That's right here. That's where it hit on Friday, and it got up to 12,295, I'm going to call it. And I actually think the high was 12,300. So it actually went a little bit above it, came back down below it, closed below it, just below it. So same type of account, A, B, right? It's a minor 2. We had an irregular B wave. It also came down to, I think this one got a little bit deeper than 1.302, which still was clean because it rallied very strongly right off to it. And then we just went to the races, and we had that gap, same thing, Thursday to Friday. We had a gap in both markets, and then just continuing up. But I can go 1, 2. It's a little bit different here. You can go 3, 4, and that's a 5. And that because of the NDX and actually the SPX, we can count on both that they could be done. I don't believe at this juncture that one would start declining significantly versus the other one not. And the reason is, of course, because the heaviest weighted stocks in the NASDAQ are also the heaviest weighted stocks in the S&P. The Dow, on the other hand, it can go off on its own because the weightings are different. And it's 30 stocks versus 500 and 100. So, but I would expect that the NASDAQ and the S&P will move together. Now, that would then suggest that what we have here is, again, 1, 2, and this is only wave 3. We get a small 4, maybe back to 12,200, maybe. We always get a little bit bigger move here, price-wise, from the NASDAQ. And then we run up again, and we make our way, or the market makes its way to 12,387. So 75 to 87, maybe even as high as 12,400, to all plus or minus that 618. And that just puts minor wave 2 right into the most common area for a minor wave 2 to complete, or a second wave to complete, let's say. So again, we're going to leave that open because 50% also stands pretty good. So on the Fibonacci basis, yep. And guess what else is right there? The hourly 200 EMA and the hourly SMA, which is just above all of this at 321, 12,321. So again, if we aren't there, we're very close. Come down to a fourth wave, come back up in a fifth. Wherever this stops, you got to allow for it to go another 190, maybe 200 points from it, right? If it gets down to 12,200, 200-point rally. That's what we've been witnessing. It'll come off and then it'll rally back, And then we're truly back from the low, it'll rally up 200. Now, if it occurs, you're going to want to trade it, but with the understanding it's not a new bull market. It's not a continuation. Can it continue? Yes, I will give you that. But again, let's just keep in focus. What truly has to happen for both the NDX and the SPX to continue and build on a rally is that the bond market can't go down. The bond market should continue to go up. Now, so coincide the two. I'll be over there. I'm going to talk about them shortly. Yes, they have rally potential still, but I'm going to be presenting within the interest rate market an alternate, which would show that maybe they don't, or if they do, it's going to be limited. Now, back over here. Excuse me. So to recap, what we can do here in the NDX, put in a little 4, rally back up, finish this C wave, put the minor 2 above it, and then start looking. I'm really not looking that hard, because it should start pretty much immediately. I would be looking for the third wave to begin with a price rejection of how high it gets. The market will just reject it. Boom, that's it. Kaboom. We just don't know where that's going to be right now. So, moving averages. So we're sitting right now on the hourly only at the 200s. A little pop above it, and then a rejection, keeps those flat, keeps those right in line, and then these all start to turn. As this turns, the 20, the 8, and the 4 could quickly zip back below that 50, which did turn up on the hourly chart based on this intensity of the rally. It was a quick jaunt because Tesla needed to close at a particular rate. Apple needed to close it above 150, and it was starting at like 144. So over 2 days, it just got, yep, we're right there. And you saw how fast it went. So we go back down the line where a lot of these stocks need to go, like Microsoft. Started at 245 on Wednesday, right? Coming in on Thursday, it rallied 6. Then it rallied 4 to close at 255, which was a strike price. Now that adjusts itself, right? It may have been May was June for 250, but the premium and the trading just through that just overflow, so to speak. So we may see that overflow again here when this all ends. But the bond market needs to stay the same. But right now, I think upside, yes, we have potential. Drop down. If we begin to drop, but we hold, so even here, we close to 290. If it goes down to 200, that's a 90-point drop in the cash. Yeah, can do it easily. Just the same high flyers just take off what they just put on. Brings us right back down to here. So dropping to here should be nothing. And I wouldn't expect it to go too far if the intent is to run it back up. Time, I think, is of the essence as well. The closer we get to that meeting, the more that people are going to start paying attention to what exactly are these governors saying. And we already know that they'll be out on the stump leading up to that meeting. All right, enough said about the equities. Let's go over and start looking at the interest rate market. First up, we're going to take a look at the 30-year note. First thing I want to talk about is in the 30-year note on March the 3rd, the rate on the 30-year bond was 4.03. So it reached 4%. Now, I want to explain something a little bit different because we're going to look at, I had marked on the daily, I had marked this low as 4.40, which was the low on a yield basis, a high on the yield base, a low on the bond price basis, the October, actually now, that would have been the December contract. The December 22 contract revealed to us that the yield was 4.40, because we're talking about that the rate on Friday was 4.03. So you're like, well, wait a minute. So this is only 0.4%. No, this is basis the June contract. This was the December contract. This is the June contract. Things change. If we take it down to the hourly chart, you'll notice there was this gap. And that gap was the difference between the March and the June contracts. Okay. So it's a continuous chart, but we always have to make exceptions, even within our counts, that we continue to use the same fib, and that fib right now is 121.30. And what that would suggest, again, if we go back out to the daily chart, the larger picture has not changed in terms of the fibs, in terms of what we're looking for. But if I were to take this and put it back into somehow that December contract, the moves would have likely taken us below 121.30 basis that contract. But we did break down below 124.11 within the June contract, and that was on Thursday. So on Thursday, we dipped below 123.08 and then went back and grabbed it. So this actually, to me, could be the completion point. In other words, on my preferred count, by the way, that's the alternate count. I'm going to bring that in just a moment. The way it's counting right now, we have wave A. So we're looking for an intermediate B wave, right? And within it, it's going to be an ABC of minor degree. Well, there's the A wave of minor degree. So we're still in that B wave. And I can go A, B, and put a C there and put the B, the minor B, right there. And then what's that suggest? Suggests that the 30-year bond is going to rally back to 132 to 135. And that was a pretty good start on Friday. They came in and they were covering, they were doing a lot of things. But again, I believe it had a lot to do with the derivatives, with the options within the 30-year bond, the 10-year note, the 2-year note, the 5-year note, the Fed funds. Excuse me. They all have options. They all expire. A lot of stuff happens and rolls right around it. So again, was it truly reflective to do this type of a rally, which may continue in the face of a 50 basis point hike come second week or so of March? Yeah, it could, because we've already seen it being priced in. If this is the level where the rate is 4%, and we were sitting around 3.6 to 3.5, and now we're back at 4, that's pricing in a 50 basis point hike. Now we're just all about trading. But it's like a readjustment to that, a readjustment of we had expiration, a readjustment to how things are going to trade. So we don't want to get wrapped up as trading itself, unless you're carrying positions in this market. We have the technical possibility that if this indeed completed a C wave and we're going to go up, C wave, and then not an intermediate B, it would be a minor B wave, then we're going to go up in a minor C wave, and that minor C wave will come in 5. We'll be looking for 5. If I come down to the hourly chart and I'm looking right there, I want to see the development of 5 waves, but they're going to be 5 waves of minute degree to finish the minor. And that's all. It's as high as we need to get, to be honest with you. So there's just a lot going on, and the bonds can do it and not necessarily change the outcome of where the bonds will end up if they do put in a 50 basis point hike. I would think they're going to end up back at the 4% level. Rally up, rally back down. So it's in between. And it's not suggesting, oh, the Fed's going to pivot, Fed's going to do this, Fed's going to do that. It's just the way, the ebb and flow of the market. There will be a lot of trading going on. Oh, I need so many of these. I'm going to go move into that. I'm going to capture that rate. So again, a lot of reasons to be trading. We just need to get along with it. So what I'm trying to just work with now is like, really, what could be coming into play? My alternate count would suggest, because and I'll tell you why I'm loading this up now. As I move out and I look at the Fed funds, And I'm looking at the Fed funds that go every month. So we have futures every month. So we have the June contract and we have the July, the August. But the major ones, of course, are going to be June, September, December. And so those are kind of like the goalposts. You know, what will we be if we're believing that for March the Fed is going to raise 50 basis points? Okay, that's already been, we already know what that price is going to be. Now we're looking out at June. So what are they going to start to tell us up above and beyond this 4% move that we've now seen down to 4%? Where will that June future? Then we start to look at the June Fed funds, and they're over 5%. So, okay, so where does that, what do we need to do to adjust on these others? Go down another quarter of a point below the 4% to 4.25, 4.5 to 5. And if this in December was 4.4, I'd have to believe that basis the June contract, it would be equal. And then if I'm looking at the Fed funds that are coming, that will really expire in September, what's it telling me in September? In September, against the chart in the Fed funds, they're moving below the 2008, 2009 low. So the rates that we found in 2008, 2009 Fed funds, which was also a very strong deflationary period where we saw that was the great financial collapse, right? So the rates got as high as, at that time, I think it was like 5.4, 5.5, somewhere in there. So we're now that equivalent but in September is coming to new lows. So it's new contract lows are being registered. That's not sitting in this market because all we need to do is we're trading to the next expiration. We're trading to the next level. And that's going to be based on what the Fed actually does do. So once we get this March meeting done, the focus will shift. Yes, we'll be looking for things in between to maybe work their way to that June level. And then that'll be filtering all the way down. I'm hoping this is making sense. So outside of all of this, now one more thing to look at here, and the alternate count would suggest, and this is something I've discussed with a few people, that I told you we're looking for an intermediate B wave, a counter trend rally. If indeed I keep going out to the next three-month cycle, right? So of interest rates, they continue to point to higher rates. So which is going to suggest in the bond market and the bond price, we're going to continue to look for additional lows. So that would suggest that we're dropping into that intermediate C wave down. So this rally phase would be complete. And it didn't even come close to getting to levels that we normally would associate with the B wave, particularly one of intermediate degree. It points to a lot of weaknesses that are not being recognized in other areas of the economy. So either that or we continue to look backwards to determine what we want to do going forwards. And we're looking at, like what Apple says it made X and this company made X. And for example, Salesforce coming out and saying, well, these are our sheets for the next 3 months and the next 6 months. We're going out. We're telling you, we're going to make money. We have the contracts. Okay, I don't disbelieve you, but everything has to remain the same, right? There can't really be any changes in the underlying currency. There shouldn't be any changes in the other underlying climate, economic climate, so to speak. So all things remaining the same. Yeah. But we've already seen a pandemic toss economies just right out the window. cost budgets right out the window. You've got all those contracts. We're supposed to give you this money. We don't have it. We're going to cancel the contract. And maybe there'll be a fee for it. Who knows? That's corporate. But I'm just telling you, there's things that can happen and change this whole picture. There are events that can take place and change this whole picture. But right now, I'm not going to look back. I need to look forward. And the forward looking is telling me that the interest rates are continuing to go higher. So again, I'm going up to the top of that pecking order. What are we looking at? Interest rates. The actual physical interest rate in the 30-year bond closed up against having this big, gigantic rally on Friday. The rate still closed above where it did the week before. Interest rates are continuing to go higher. The market is telling us that. Okay, equities, you can go up because, yeah, we needed to get up to those levels technically. Now, interest rates are telling you that level should not be sustained because of what it takes to get there. And borrowing costs alone pull it down. So again, if we just keep in mind what really is taking place when we have higher rates, how deep does it go? You might have $500,000, $1 million, $5 million in your account. But if you're going out of margin and you're paying to carry something, that really can't hold its value because it's too much. It's too high against the current interest rate. My cost of carry. Don't forget the carry trade, folks. Boom, go check it out. That's borrowing money to make money. But the cost to carry it outweighs what you think you can make or changes the parameters of the carry trade. If you're going to borrow money, you got to cover your costs. Well, suddenly it's costing you more, so that cuts into where you think how much you think you can make. Now, where's your target? Your target has to be bigger. Can it get there? Probably not. So everything starts to change. Back to this bond market. If this B wave, then I'm looking at 1, 2, 3. We get a little fourth wave rally, maybe brings us back up to, I think what I did is I'll just put the fibs in. How about that? Again, 30-year bond. Now, mind you, when I get down the list, it'll go much quicker because I'm explaining everything on the 30-year. All right, so if we had a little fourth wave, 382. How about this? Take it down to the hourly chart. 382, 126.16. Well, we got up 1 1/4, 1 and almost 2 points. Almost 2 points on Friday. What's 2 points from here? Above that one. So all we need is one more day of like excitement, one more day of like shifting, one more day of whatever they need to do. Comes in a 4 and we slide down in a 5. Going to go back out to that daily. And I'm going to take off 120, take off this guy. I think I can take off. Yeah, good. So 126.23 as well. The way 26.11, 26.23. That's just going to be 382 of, yeah, it would be on the way back up. Because on the way down, it was support for our B wave. On the way back up, it's just slight resistance, probably is going to hold because the only thing that's behind it is the 20s right in front of it and the 50s right behind it. So again, if we're starting to rally back up in a C wave, this is A, this then becomes B, right? If I have to mark this A, B, and I can get 1, 2, 3, 4, 5, which I can do, then I'd have to put a C, the minor C wave here, minor B wave there. Whew. And then we rally up in a C wave, and that would be expected to bring us back. So this might just be wave 1 of C, 2 of C, 3 of C, 4 of C, 5 of C. We end up back here. This turns into basically a flat. Then this B wave moves over. We'd be looking, I honestly would be looking for it to break above 132. It got up pretty high. got up above 133. So get back closer to there. Do I think it can happen? Personally, with this huge pall hanging over the market and that September contract making new contract lows, I'm like, man, I don't know. Unless if they start to toss the banter that maybe, 50 basis points in March, and then maybe we'll do only 25, or maybe we won't do any. Then they're going to start to try to figure out, how do we price April? Now, how do we price May? Because we know what we're looking at for June. Then what's it going to look like as we move further from that? So then we have September, et cetera. So you got to, you have your cycles, your expiration. Anyway, that's the alternate count here would be here. And what I'm looking for, if we're in an intermediate C wave down, I'm looking for 5 waves of minor degree, but in the opposite direction, and they will be numbers. And what is this? That's what this represents. So I have minute 1, 2, 3, we get a little 4, we get a 5, minor wave 1, get out of the pool, kids, because it might end here. Minor 1 could end up down here. I just went through that whole long explanation that it's not going to represent 4.40. It's going to, on basis the contract that comes down there, I believe it'll be higher. So interest rates continuing to rise. Then we turn 1, 2, 3, 4, 5. Then we turn and put in, guess what? Another second wave, because it'll be minor 1 of intermediate wave C. Little bit larger picture on that suggests that we go much further down. And I'd have to take all this off because the connection comes in that we're going to be going up. I'll tell you what, let me go to my short-term weekly. We start up here, we go down to there, we run it up to there, and then we look to see where it goes. And quite frankly, I already did that, and it comes down about 84. Where a C wave might be equal to the A wave, or even a little bit lower. But it's a huge drop. And I've been trading for a very long time. And it's been a very long time since I've seen those levels in bonds. Doesn't mean they can't be reached again. But it'll be a nasty ride down. And then again, we're looking at the equity markets not doing very well, but that fits our counts as well. So while I do feel that we're going to come down and we might equal this, I'm basically showing this as an alternate because, again, I don't know what black swan event could or could not happen. It's all sitting out there, but just so I'm not going to take a posture of like, oh, that'll never happen. Because guess what? That's normally when it will. So I put it out there, but I'm going to come in and I'm going to trade because that's what I am. And if you guys want to, if you're in here trading, don't get married to a position. Don't get stuck on a position. Be able to trade with what they're doing. There are a lot of funds. There are a lot of people. There's a lot of companies that are out there trading, and they're going to be making their adjustments. And we're going to have to live with it. And it doesn't necessarily suggest what is going to be happening in 2024 or 2025. That's the long-term picture. We're just looking at what's going to happen in June, what's going to happen in September, what's going to happen in December. We're going expiration cycle to expiration cycle on different levels. That's how it trades right now. That's what I'm talking about in the equity markets. But in the equity markets, they've knocked it down to day by day by day by day. Don't forget that what it was years ago, it was quarterly. March, June. Then we had September, then we had December, but then you had other 3-month cycles. So a lot different. All right, going down our list, let's go to the 10-year note, because again, what a lot of people do is they compare the 10 to the 2. It's actually the same picture. That's our weekly. I'm going to come down to the daily so I can show you. Here as well, Oh, first, the 10-year note on Friday closed at 4.08. I marked this as 4.25, and let's go back and say when it was there. That was in October. The October low was 4.25 because it came at the end of the month. The October low is basis the December contract. We're now in the June contract. And the June contract on Friday came in at 4.08. So I would imagine that this probably still is 4.25, maybe a little bit greater. Is it 4.5? Now, whatever it seems to be, I'm going to go back down to my daily chart. What I have been counting again, we had the 5 waves down, intermediate wave A. I'm looking for an intermediate B wave, which may still or may not be in progress. So far, I've been counting this as the intermediate, not intermediate, the minor wave A of the intermediate B wave. Then I got an A and a B. And this, friends, could be the C wave. It came down. It really did. It broke below a low that I thought, maybe should or shouldn't. But it did, and that was fine. It fit the count. And it looks like it could be a nice 5 waves down. Wave C. So yes, I can put a C wave there. And underneath it, put a minor B wave. What would that suggest? We rally and we go back to 116, or actually just above. And that would be the A, the B, and a C. And it should do it quickly. Now, can it? I can't say no to that. Of course it can. What's going to be the catalyst? I think there'll be many things, but most of it's going to be as the contracts roll, how it's pricing in where the interest rates are to what the bond should be doing. Because again, if I come down to the hourly chart here, same deal. There it is. The switch from the March to the June contract. That's what the roll. Oh. So it continued to decline, and we weren't looking for very much here. We were looking for it to decline, but it needed to hold that. First of all, it needed to hold this level. It appeared that it started to break, and the next stop would have been 108, but it found its footing and it jumped. Now, is it just a third wave? This is the third wave completing, and we're going to do a 4 and a 5, and it still ends up being the B wave? Yep, I have to include that all the way down to 108, and then still do a rally back up. Same thing in the 30. But again, balancing out against what the Fed funds are saying for June, for September. They're making new contract lows in September. And again, that's over the 2009 lows. So trying to put that together brings our situation that, again, it's the B wave is done. And the weakness is in bond prices. The rally is going to happen in bond yields. So it presents a lot of challenges, I'll tell you that. But I would not be looking again for the note to rise, so the bond price to rise. I'm looking for it to continue to fall. Same basis. I'd have to run from that high that we had in 2020 down to this low, up to that high, to show me what would look like coming off. And you can see we're all way below par. Way below par. And nasty. Interest rates through the moon. How high? I don't know. But this we're going to continue to take our clues. I'm not going to go, I can tell you what my Elliott account's kind of shouting at me, but I don't know how it's going to get there. I don't know what catalyst is going to drive the market to those particular levels. So I'm not out there yet. I'm going to stick here. And what it really, again, comes down to, if we start at the top, it's like, what are the interest rates telling us? Where do the bonds need to be priced? How does that affect our currency? And then how does that affect our stock markets, our equity markets, our commodity markets, precious metals markets? And then how does that affect us, the retail investor? What do we need to do? So it'll filter down, and either we get on board or we don't, but we do so at our own whatever. So here, what we can say about the bond market, and it's going to be all the way across the board. But as I'm going down here, as I'm going from the 30 to the 10 to the 5 to the 2, consider that each one is reacting to what is the perception moving forward. Higher rates are here for the foreseeable future. This is the message I'm getting from the Fed, from a lot of economists, from economists that are working as analysts within these large banks. They're basically saying, it's like, no, they're kind of here and they look like they're going to go. So how are we telling that? Well, we keep an eye on the Fed funds rate. They're doing this massive rally in the 30-year bond, but guess what? The June Fed funds closed unchanged. That's the closest we are to that March hike. Then we'll see some movement. Okay, now we got to either price a lesser hike or whatever for the next expiration cycle. And you'll see it all flutter around. So again, we're moving from expiration to expiration, but the message continues to be the same. So our larger picture, what affects the top of that rung, of the top pecking order? Interest rates, what's affecting them? Well, of course, the Fed, inflation, what's going on? They're going to be consistently raised. Factor that in, and don't get married to upside or downside, just be able to trade. That's it. That's my strong message. We just want to make money. Do you care how? And you don't, and I'm not going to get wrapped up in a conversation of like, well, this one says that and that one says that. It's like, so what? I don't care. The market is the market, and it's going to do what it's going to do, regardless of what somebody says. And what somebody says may be fleeting. So again, could be. If so, we're going to go up in a fourth wave. We're going to come down, and we still might only come down here. And again, here we are in the 10-year note. We're not that far away from 108. But if it's the alternate and it comes down, it could hold it, be -1, rally up in a -2, instead of coming all the way back up to here, right? And then trip and turn and then start to break severely. Now, that could all happen in the next 2 or 3, 4 weeks, for sure. Okay, going down to, my friend, the 5-year note, and you're going to see each time what's happening to the interest rates. First thing we're going to do, go out to the max. That's where I put them. On the 30, on the monthly, or you can just write it down. You're going to see a little bit higher jumps, right? On the end of February, we closed at 4.19 or 4.20. A week later, we're at 4.32. We're going up. Every week, we're seeing an increase. And now you can see for the month of February, right now, every week, interest rates are going up. So this folly, oh, they're going to boost, they're not going to boost, they're going to cut, they're going to pivot, they're going to do this, blah, blah, up and down, up and down, up and down, up and down, up and down. Now we're just starting to decline. That again gives me a little bit more strength to say, well, there's a very strong possibility that is the intermediate B wave, and interest rates are going to go really higher. But the market's beginning to tell me that. So I'm not so far, we're not jumping off the end of a cliff here. We're just following what the market, I believe, is trying to tell us. So if we come back here to the daily, we're going to take a look. 5-year note. Back at the end of October, again, oops, I forgot to stick what that one was. The end of October was 4.45. Again, that would be basis the December contract. That's just long gone. Coming back out here, we're going to like that. Now we're going to bring this up. 4.45. This is 4.3, excuse me, here. 4.32. Wow, okay, 4.5. Well, it's not that much. Neither is the drop. Off of that low that we reached on Thursday, it is less than a full point. All the way down. So I think it would come in at higher than 4.45, but not a whole lot. So we still could drop down there, put a B underneath it, and rally back up. Or 1, 2, 3, 4, come down in a 5, minor 1, minor 2, and then really start to drop. This is what's out there. Again, please bear in mind, what is the market telling us? Start looking at the Fed funds. And truly, the most basic model, bonds are always priced at par. That's 100. You take the price of the bond, subtract it from par. You're getting the interest rate approximately. So, and then always check, because there are many services that will tell you each and every day, what's the yield from today's closed? You can find it. So the 5-year, same deal. We got a little bit, we can come down to here, rally back up into 2, and then sink like a stone. Or we're finished here, we're going to put a B underneath it, and we're going to rally back up in a C wave. Both carry weight, both carry possibilities. What is seeming more likely? It's done, and we're going to drop. We still have a rally to do, actually 2. This is a little 4. We're going to come down in a 5, put a minor, got a little bit bigger rally back up here, and then the big drop. So what are we looking at? Mid-March? Maybe a little bit longer? We'll see. All right, over here now, back down, we're going to take a look at the 2-year. 2-year is kind of, believe it or not, Big Daddy after the Fed funds, because it's a 2 compared to the 10 where they get the inversion. And interest rates are inverted. So in other words, the short time, the short term, the 2, the 5 are increasing. The rate is increasing faster than it is on the 30 and the 10. And basically the big comparison is the 10 versus the 2. Now, here in the 2-year note, we did drop. We did come back to the 100% retracement off of the high of what I'm putting a label on as wave A. Now, if I have to mark this as the completion point of intermediate wave B, 1, 2, 3, 4, 5, minor 1. So this is what I'm telling you that I can think can happen in the 5, the 10, and the 30. Off of that level, 1, 2, 3, 4, 5, except in the others, it appears that they've only reached the 3rd. And here the 2, which is always going to be a little bit ahead because it's the Fed funds 2-year note. And we actually, you can actually put together another picture, because you can look at 4-week T-bills, 8-week T-bills, 13-week T-bills, 26-week T-bills, all the way up to 1 year. Once you start getting over that, they're no longer T-bills, they're Treasury notes. All right, so could it be? Yes, it could. And that would be a minor 1. I will fill this in because I'm not convinced of it just yet. So that's why I'm leaving this open, but I can count it out for you. A, B, C, that could be the intermediate B, could be. What is the message behind that? Look out below. Or if you're on a yield base, look out above. We're getting ready to do a moon launch. So understand the moon launch It takes time. It might get out of Earth's gravity, but it takes time. So we go back and forth and we, do what we do. 2-year versus the 10. The inverted interest rates are not getting better. They're getting worse. They're getting greater. So 2-year. Ready? The 2-year note on Friday closed at 4.89. So from the beginning of February to the beginning of March, the interest rate, the 2-year note, has increased almost, over 50%, over 50 basis points. And we're now heading towards 60 basis points. So is the 2-year note already beginning to price in what the Fed funds may be telling us that are coming for April, for May, for June? Very possible. But should we have a little bit of a bounce here? Yes, we should. And that might only take us up to the actual March number, Fed decision. And then a lot will be on what the Fed says, how things are going. What do they feel? What does it look like? So again, start at the top, work your way down. All right, finally, I'm going to go over into the US dollar, which actually is sitting on the fence right along with everything else, waiting for interest rates. Tell us what we're going to do. Here we have the dollar. We're looking at the monthly chart, but I'm going to bring it right away down to the daily chart because this is getting a little bit long. So I'm just really sticking with equities, interest rate, and the dollar because those are the top. Gold and silver, I will get to another update. Here we have our initial wave down. I'm feeling that we're in a B wave up. And right now, 1, 2, 3, 4, I think we got one more rally, likely closer to this 382 number, 106.15, getting just above 106. We've got right now we're kind of buffeting up against and being controlled by the 200 EMA, but I think we can break that and run ourselves up to the 200 SMA, which happens to sit just above 106 at 106.45. So the fib is 106.15. The 200 is 106.45. Could catch it on a spike, and then we come back down, and that then would complete likely wave A of our zigzag up. So what does that tell me? That begins to tell me, unless we turn right from here and we sink, I'm going to count it as 1, 2, 3, 4, and then 5. Good, right? We need to come down. It needs to break. It needs to come down and get itself below. I'll give it there, 103.90-ish, but in reality, 103.70, 75. So it's breaking there. Then I'm going to leave this as an ABC, and we're coming down. Before, again, we find our footing, likely back here, and then rally again. Ultimately, I find that wave B should come up. We always discount it, but it should come up 107, 108, maybe even as high as 109. We have 50 to 618 for B wave. Absolutely. Very similar to wave 2 in terms of fibs. And that brings it all the way up to here. What's it to see? And then now look at that. Again, this is just a daily chart. What does that tell us if the dollar is going to go up there? Why? Well, because interest rates are going there. The need for dollars is going to grow greater. So roll with it all. When you put your big picture together and you look at what they're doing in the equity market, you'll begin to see, even though it might be controlled, there isn't anything really bullish about it. So we need to trade in the same vein and the same mindset as they are. And what the dollar's telling us is a little bit longer out. There may be a very strong chance that yields, rates will go up and more substantially than they have. All right, this is where I'm going to end it for today. I want to thank you all for listening to me. Again, any questions or any comments, please feel free to leave them. And as far as podcasts, I'll be doing one more tomorrow. and that'll be with Dan Ascani. And I believe our discussion is going to be just taking a look behind the curtain. We'll be reviewing the week and adding a couple of things, and also talking about how we want to build our new trade room. And it's just going to be a revamping of the current logical signals trade room, which is my current trade room. And we're going to be adding different products. We're going to be adding different technical indicators, and really continuing our focus on very short-term trading. So basically day trading, maybe a couple of swing trades, but that's going to be up to each individual. But basically we have become more of just day traders. But we have the NASDAQ, we have the S&P, we have interest rates. Excuse me. We have gold, we have silver. There'll be those that want to trade the dollar, so et cetera, et cetera. So I'm going to try to put together a trade room where ideas, thoughts, levels can be given across on many different asset classes type stuff. All right. Thank you so much for being with me tonight. Thank you for listening. And our next Elliott Wave update will be tomorrow with a podcast as well. Have a great balance of the weekend.